since everyone else can.
Okay. So welcome, everybody. Thank you. Teo Bogdan and myself hope to be able to cover some of your questions. I believe format today is going to be some questions, and look forward to taking any questions anybody has down in the chat box if you guys want to type those in. If you have any questions leading up, or feel free to chime in at any time, and hope to cover all your questions that you may have. So did you want to start, Teo, or?
Yeah, I was just looking. There's someone sent me a message. They were trying to jump on, but they couldn't.
Okay. This is our first time doing this, everybody, so please excuse some of the technical issues, but I think moving along, so.
All right. So I guess my thing that I wanted you to kind of talk about was like a cost segregation study.
Okay.
And how that works.
Okay.
I think that's one of the biggest benefits of multifamily.
Yes. So brings up a great point with as multifamilies grow, I think a lot of single family investors are on the call today. As the deals get bigger, essentially in a multifamily deal, a lot of the tax benefits such as depreciation and that really come into play. On larger deals, advantages such as cost segregation, which is, for anybody that's not familiar with it, it's an actual engineering study that's done that's going to identify the component elements of the property. So, for example, if I buy a multifamily property, let's say for $1 million from the previous owner, the cost segregation study is going to come in and do an analysis, because on a multifamily, I'm buying a lot of furniture and fixtures, appliances. I'm buying maybe clubhouse equipment, a lot of other things that are going to be tied to that are going to qualify to be broken out separately for depreciation purposes, rather than just a 27.5-year residential rental building. And so if, let's say, $2.75 million, you're going to take $100,000 a year in depreciation. But on that same deal, if I go in there and let's say $1 million is allocated to personal property, my year of purchase, I might get $1 million tax deduction for the segregated items if they fall under accelerated depreciation rules. And that's really where the advantages are. And I think as people venture more in their real estate investing, for example, that $1 million depreciation does have some limitations depending at the investor level. So let's say Teo is a full-time investor and he is a partner that has a W-2 job. That partner may not be able to use all the depreciation in that particular year. There is some limitations there, but all that aside, he's not losing it. He's just deferring it into the next year. So
that on that point, so they can't use it because they don't have enough passive income, right? Because you can only depreciate. Is that kind of where you're going with that one?
Correct. So if I'm a W-2 investor, I have a regular job, I invest with you, and I make less than $100,000, I can deduct up to $25,000 a year against that. So in that case, if you had a bunch of passive partners, the cost segregation would be there, but I always like to understand the client and have a planning strategy in place, because a study could be done, but if it's not going to provide a direct benefit, then it could be unnecessary. But as your investing strategy grows, you're going to get more deals under. And I think a lot of the investors that are on today, the ultimate goal is to really subsidize their W-2 income, or exit their W-2 and get more actively involved in real estate, which then, as they get more involved in real estate, they could qualify for real estate professional status, or their spouse could qualify. So for instance, let's say I'm a W-2 employee, but my wife is a real estate professional. We are both viewed as real estate professionals for tax purposes. So that accelerated depreciation that the cost segregation study frees up would offset my W-2 income. So it's really with proper planning, but cost segregation is actually one of the greatest strategies with larger multifamily deals. Actually have a few deals or a few client projects working on right now that are tied up either with the cost segregation just got wrapped up or it's being wrapped up. So that return is going to go on extension. But in these cases, it's putting probably about 40% of the purchase price in current year deduction to those investors. So based on the time value of money, it's a great deduction. And for an active investor, if you're adding a deal every year or every couple of years, it's effectively giving you great deduction this year to offset that deal you did 5 years ago where you're running out of deductions. So that's something to be aware of. If I take it today, I have less to take later. But based on proper planning, if you're rolling into new deals, it's really a great strategy to increase the wealth and increase the overall your net worth is what the bottom line goal here is.
And so you mentioned how long you could depreciate something. You said 27 and a half years. That's like residential. Is commercial separate or different than that?
Yes, so commercial is 39 years. So for example, if not necessarily multifamily, but let's say a large office building or something, I go in and buy, and that at a standard is going to be 39 years. But if it's an older building, let's say that just has some floors, now you're building out the suites for your tenants and you have interior doors, non-structural walls. That's a lot of renovation that becomes very expensive. That's going to generate qualify for accelerated depreciation in that case, so that $2 million building can get a very substantial amount of depreciation depending on what type of use it is. If it's just general office or more like a medical that might have specific electrical units and all depending on what building improvements have been done. If they're more toward uh, not the overall building, it's going to qualify as more of furniture and fixtures and machinery and equipment for that electrical hookup that's pulled in to run that specific medical device, as opposed just to the electrical that's run into the building for the main lighting. So,
Cool.
but that same buyer, if I buy that building, I just bought a building, and that's really all that my sale documents. So the cost segregation is really going to identify those components and free up that depreciation.
Um, how would it? So we're kind of talking if we were to buy a deal. Let's say that I put together a syndication and I had someone that gave me $100,000. How would they still benefit from the cost segregation study, and like by how much?
So if someone gave you a hundred grand into a deal, it would really depend on they would benefit in the sense that they might get a great amount of depreciation this year, and then worst case, let's say they make over $150,000, that loss is going to be limited on their return, assuming that's their only investment. They could use that loss against other passive investments that they have within their return. So if I invested in some deals 5 years ago that are generating some amounts of income this year, I can use your deal to offset that deal. But on another note, if it's if I don't have those deals to offset that or use that cost segregation to free that up, I'm going to effectively just carry it forward. So I don't lose it. I just don't necessarily get the benefit if, let's say, I make 300,000 a year. I'm a W-2 employee, and I'm not going to be able to free that up. But it is still an advantage, depending on the size of the deal and the number of investors. It's worth at least understanding the cost of the cost segregation study as opposed to the benefit. If you had 100 investors that were all passive in the deal, it may not make sense just because they're going to get all such a small piece, and it would really depend on what the benefit is. You have to look at that also
Yeah.
in the study.
That, I guess my main point in asking the question was that I know when I've raised money for stuff, people have been like they get the cash flow. Most investors do. But a lot of guys that are more sophisticated that have been investing in all sorts of stuff throughout the years, they really like that they get to take advantage of that, the tax.
Yes.
So that's kind of why I asked that question.
So, for example, if I invest 100,000 and then I get 100,000 of depreciation this year, um, if that's my only K1 investment, then I probably won't get a benefit. But if I have other deals, because I'm savvy enough to understand that I'm probably in some other deals, um, it's those guys that are looking for it, and they're investing in your deal first because it's a good deal. Second, because of some of the advantages that they can get and that they're going to use. So it's really understanding your investor mix and what that is. But I always say it's worth looking at. If you had a group of 10 new investors that were all W-2 employees and you had the cost segregation and this is their only deal, there's probably no immediate benefit. I still wouldn't necessarily say don't get it if they understand what the benefits are. So they might have some passive carryovers to use against the deal they get into next year. So it's not bad. It's just not, when they come see me this year, they're not getting a big refund on their W-2 income.
Right. Right. Okay. Also, you mentioned a K1. I don't know how familiar everyone on the call is. Can you tell us what a K1 is?
Okay. So, so I think everyone's familiar with LLCs and more on single family. A lot of people have LLCs that they've set up, and most of them may be single member LLCs that really are what's called disregarded entities for tax purposes. As you venture into larger deals or deals with other people, you're going to run into what's called a multi-member LLC. And that multi-member LLC for tax purposes is taxed as a partnership or an S corporation. It can be. By default, it's a partnership. And if I'm seeing Teo and Tiffany and Barry, if the four of us were partners in a deal, we would be filing a 1065, which is a partnership return, and each getting a K1, which would show our, assuming we're each a quarter, our 25% share of all the items of income and expense. And that K1 is pretty, it comes with an S corporation or a partnership. For buy and hold real estate, we'd want to have that generally in a partnership formation, not an S corporation. There's some complex tax reasons too. If we were more of a service business, we might want to consider an S corporation. So for what we're talking about, I would say partnership 1065 is all that we would apply to.
That's if you're partnering with a bunch of people, right?
Correct. Or just one person. It could even be you at 99 and your partner at 1%. But with the LLC, there's more flexibility. It's the reason you don't want to be just a standard partnership also.
And if you're syndicating a deal, so let's say you're actually forming a syndication, using lawyers, doing all that stuff, it'd be a similar sort of breakdown, right? Depending on what the split is between right?
Yes. So for instance, in that Syndication would really be more similar to different classes. So we might have the A and B classes that have, um, we might have the different classes. Let's say the A investors are investing the capital and are getting some preferred return of some type. And then the syndicators are going to be what's called the B investors in this case, and might get an equity stake with no investment or small investment. And then on top of that, there may be some acquisition fees or developer fees that they get in there. Many times it would be indicated that it's going to the syndicator or some entity that they have. And that's the type of thing that fee, let's say I was getting a $10,000 acquisition fee for that. I personally would want that to go to my other LLC that I would disclose to my partners. But for tax purposes, I would probably want that taxed as an S corporation, because I might be able to structure it to minimize my self-employment tax, because that's more of a service that I'm getting paid for. I might send it to an LLC that maybe me and Teo, let's say, are the organizers and the partners. So our other entity is going to get the syndication fee, and then he and I can figure it out with our books and records and the management. So really with this LLC, you can have different classes and different distribution percentages. So if you're distributing, let's say $100,000, that syndication document would dictate the ordering, whether it's a return of capital or it's a management fee first. So getting all that structured in that. And at the end of the day, all those investors are going to get a K1 out of that deal. It would effectively be a partnership. And that partnership doesn't really look any different than a partnership that you and I would be in at 50-50, except the allocations are different, more special allocations in the way you allocate the debt.
Okay. Does anyone else have any questions before I keep asking?
Any questions from anyone else on the line?
Hi, Nicole.
Hey guys, this is Nicole. I do have a question. I'm not quite sure how to ask it, but in regards to using an out-of-state investor, what type of legal and tax ramifications might there be if someone were to lend me, a certain amount of cash to buy a property, or if, say, actually they purchase it in their LLC, they're out of state, and then transfer the property to me via land contract or installment sale?
Okay.
I'm curious to know what kind of ramifications it would be for the person holding that LLC that's out of state.
So I just figured out something this past year that's like the best thing ever in my eyes. So I started lending like hard money last year, and I figured out that it ends up being taxed passively as passive income, all the return I get off of that, which is taxed way less than if I was to buy a property myself and then sell it and then make that much money on it. Right, Frank?
Yes, depending on how your deals worked out,
Yeah.
I would say that it's probably structured as a form of interest and some type of interest premium
Right.
versus.
So I have a mortgage on it, right? I'm like the bank, first position on the deal.
And you probably get like a minimum amount of interest and then some type of premium based on a profit split.
Yep.
Or
Points and then a percent. So what I would say, Nicole, for that guy or person, the most beneficial to him is he just gives you a loan on the place, unless you guys like partner on it and you want to split the profits or whatever it may be. But I think the most benefit, Frank can jump in and correct me, but is if he's passive, because let's say he on the deal he ends up making, I don't know, let's say 10 grand, 20 grand. that just gets taxed at a much lower percentage as him being passive, right, Frank?
Yes. Also, I would say, which one's my client, or uh, on another note, if I was working with Nicole, I would end up wanting to work with a deal that makes sense for her also. But with real estate, you can really structure a deal that's going to work for you. And as you're dealing with investors, you have to make them happy. So we could ask for a deal, let's say, for in her interest, and the lender would come in with something. But definitely, if he's an investor in a passive deal as a partner on real estate, it may be better for him to treat it more as interest income. And that's how, if I was in his shoes, I would prefer to be. But on another note, everybody's case is different, state by state, and Teo and I aren't attorneys, and we're just more giving some general advice without knowing all the facts. Really drill down a little closer, and I think the point of today is just giving out some options and really understanding the ways to navigate. So that's just my little legal disclaimer. Don't sue me.
Okay. Thank you. I understand.
Yeah, it depends what the end goal is, I guess, of the deal too. If you guys are gonna hold it together and get cash flow, or flip it, or
Well, at this point, I mean, you know the deal. It's the duplex I just got. So
okay.
at this point, we're looking at flipping it. And he purchased the property through his LLC. And so we're trying to figure out how to go forward from there. If we work out our own contract amongst the two of us until I sell the property, or, you know, or does he sell it to me on a land contract or whatever?
Oh, so his LLC actually owns it?
Yeah.
Okay.
Right now, yeah.
Okay.
Okay.
Uh,
And this one's just really structured as a flip at this point, is what
Yeah.
your end goal is. Okay. So I mean, really, in this case, it's probably more just a partnership or some JV agreement that you're going to split the deal. And if everything works out, it may be something that, as you build that rapport and that relationship, you become the owner, he becomes the lender if he's out of state and passive. On another note, he might want to be more active and as an owner. But on another note, if he has a mortgage against that property and just has a lender deal, he generally is going to be in a better position than just being a partner on an LLC, and especially out of state. If you're both, let's say, 50-50 partners, and he just gets a right of the first return of capital, he might be in a better position if you stop paying him, if he has a mortgage and he could foreclose and effectively just take the property back. Where
Yeah.
on an LLC, you guys would just be partners, and generally you guys would just be fighting in the legal arena and not the foreclosure laws.
Yeah, there's no mortgage. He paid cash.
Okay.
Are you a member of that LLC?
No, I'm not a member of that LLC.
Okay.
He's the full member of it.
Okay.
Okay.
And he's just charging me 4% interest on the loan, basically, you know, what he lent out for the purchase of that property.
Okay, that makes sense.
But like on your next deal, let's say you and I became partners on a deal, I could also be the lender to us in a mortgage position. So we're 50-50 partners in an LLC that we buy a property subject to mortgage. So we effectively have zero equity. We have an asset worth the mortgage, and I just happen to also be the lender, but it gives me more rights in that mortgage position, as opposed to more rights that I have as opposed to just being your partner, and especially if you're the active partner with that. So, okay.
Does that answer your question, kind of, Nicole?
Kind of. I guess I'm still trying to understand how to best structure it going forward to make sure that I don't put him in a bad position from a tax perspective
Okay.
when he transfers the property over to me and or myself, you know.
So I think right now, since you already did it, you just go with it. And then after you guys are done flipping it, he would just sell it and then just have a contract written up between you guys like, hey, because I think that's really the only thing you can do now is just have a contract between you guys and just say, hey, once we sell it, we bought it for X, you're going to get X plus interest back, and I keep the rest of whatever profit is. Going forward, how I would structure it or how I structure my stuff, I have an LLC. Let's say I'm buying something. I get money from an investor and the property gets purchased under my LLC, so I own it. But the person that's giving me the money, he puts a mortgage on my property. So he's like first position mortgage. So he can foreclose on the property and take it back if I don't perform to whatever the promissory note says. And the promissory note would just say whatever percent monthly or points or whatever terms are. And that way it's kind of more separated and easier to work it, if that makes sense.
Okay, yeah, that does make sense.
I can tell you more about how I do all my stuff too, if fine.
Yeah, we can take that offline some other point. Thanks, Teo.
Yeah, no problem.
Okay. And then I see a question about opportunity zones, and as far as investment in opportunity zones to take the tax benefits. So opportunity zones are new with the most recent Trump changes from 2017, and the acquired property has to be located in the opportunity zone, in an area designated an opportunity zone, and you have to look at the specific map. It's block by block and street by street. You could be on one side of the street that's not, while the other side of the street is designated an opportunity zone. And the advantage with an opportunity zone is, let's say I bought Google for $100,000 and now it's worth $1 million. So I have $900,000 of gain that I want to go invest that $1 million into real estate. I can cash in my gain or my Google stock and take that $1 million, go invest in real estate. And the benefit is I get to defer that gain on that Google stock if it's invested in an opportunity zone. So one of the things I see with opportunity zones is you have to be in a position that you have the gain that needs to be deferred. And in real estate, most of the deferred gains that I see are more rolled up 1031 exchanges that have been deferred over time. So I could sell a property that has a big recapture associated with it, go invest in opportunity zone and defer that. But the only problem is I can't refinance that in 2 years when I add value to that property and take that money out tax free. I lose those benefits because now I'm actually touching some of those gain proceeds that I have to leave parked for 5, 7, and 10 years, and it gets into different limitations there. So I do have a few clients that have done some opportunity zones, but some of that, but they're also in a position that they were able to park the money there for some years and got some really great deals from the cities. They parked it and they really don't plan to even touch this deal or refinance it for up to 10 years. So if that position, it's a great way, I think, to attract some doctor and outside investors that have these gains or are planning for the long term. But I think the more active real estate investor isn't going to be parking their dollars there. I think it's a great way to bring in outside investors with money. Has really been the take in the field that I've been getting with it. I know a lot of the larger, like Merrill Lynch's and Bank of America, they all have funds, but me as a stock portfolio investor, they can put me into that deal. They get great commissions, and 5 to 10 years from now, maybe I get a better return than I do on my stock in the stock market. So I see it as a product that it's a great source for developers and syndicators and that to raise funds. But as a smaller investor, I don't know anybody that would necessarily apply to. So like I said, each deal is a little different though. So it's something to consider. But if I had a old 1031 that I've refinanced and exchanged a few times, I might just look at doing another 1031 strategically and structure it that way, because I don't lose the benefits of being able to refinance it in 2 years if the neighborhood turns around and is worth a lot more. I don't want to be stuck and not touching that money for years to come. And in 2026, you still have to pay the tax on that gain that you deferred. And then after 10 years, the gain on the new property could be tax-free forever. So there is some benefits. I'd almost rather, I think the guys that are playing the 1031 game are in it for the long haul, carry the property till I die and get the step up in basis will be the best home run.
So why you can't refinance? That's because of some rule of
Well,
being in an opportunity zone, or
well, you can refinance it and increase the value of the property, but you as the partner, you and I and the partner in the deal can't take that money out of that deal, because we're effectively taking dollar per dollar some of our deferred, let's say Google stock in that example that I said, where I parked $1 million. Now, let's say over time it's worth 2 million. I want my million back. I've effectively taken my deferred Google stock before the timeframes that are in place. So as an investor or as a developer, it's a great way for me to bring in an investor that doesn't need cash flow right away, but more as an active real estate investor, I don't want to park that money and lose the advantages that I could get. So,
okay. Well, let's say you just bought in an opportunity zone. How would that work? Let's say you bought something for $1 million in an opportunity zone. It increased in value by, like, let's say it ended up being 2 million. Can you cash out refi and do it like a burst strategy kind of?
uh, you would still be able to. As far as the longer term deferral, I would have to double check on what the regulations are. The regulations actually didn't, they were changed a couple of, or being interpreted a few times, and taking new money, just fresh money, not deferring anything on the front end, buying in an opportunity zone, refinancing, taking my money, and then in the long term, holding it for 15 years. I would guess there's a deferral there, but I'm actually haven't looked at that situation all the way through, because if I did buy in an opportunity zone, to make it opportunity fund property, it's just a form that has to be filled out. It's not a bunch of legal fees. And if I bought property located in an opportunity zone, I might want to hold that in its own LLC so that I can make that a qualified opportunity fund. And at a later date, at least I didn't eliminate any options if there is any further interpretations. And so I would still advise to explore calling it an opportunity fund, but in that LLC, I wouldn't go by the property in the premier neighborhoods. I would keep that as just the opportunity zone property.
Are there any other tax benefits in investing in opportunity zones?
So the biggest one is just the deferral, and that's really the benefit there. So with the you still get all the other real estate benefits there, but it's really getting the cash, and you would still be able to get cost segregation on the property as you added value to it. So all the other benefits, but the biggest thing is really that deferral. And if you think about it, what it's done is created a lot of these tech investors that have deferred stock, and actually it was I can't think of his name right now, the Facebook guy that came from the music company that Metallica sued, Napster. But it was him that pushed it through because he has a bunch of Facebook money, and if he goes and invests in real estate, he can defer that gain. He doesn't necessarily need to be refinancing it. I can't think of his name right now, but he was big in pushing that through. And if the governors in each state selected their own opportunity zones, but so I think those people that have that deferred gain, it's a great benefit. Cash that in and really build that generational wealth there. So yeah. Oh, Sean Parker, somebody's typing in. So yeah, I couldn't remember it, his name, but yeah, Sean Parker had pushed that through along with some other people, but he was like on the tech side of things.
Nice. Anyone else with any questions? Or does that answer your question, Tiffany?
Yes, it does. Thank you.
Okay.
Cool. Anyone else have anything? No, not all at once. Do you have anything else that you were planning on touching base on, Frank?
Mainly just questions on that, but I think really the multifamily, and that was kind of the focus here, but I think multifamily and commercial is really like a next level growth from single family, and really a step. But I think everyone really knows with multifamily, there's really centralization of management. There's a lot of other benefits, and it's really something to explore. And getting into multifamily, I think you need to know what you're doing, but really the opportunities are there, and the deal size, able to bring in other investors. Teo, you mentioned syndicating a deal, and even taking on partners as you take on more outside or less knowledgeable partners. I think it's worth speaking with an attorney, getting everything lined up. The best partnerships have everything written down, and good partnerships fall apart from bad documentation and communication. But really, multifamily can really be a 4-unit up to, a couple hundred units, depending on the scale of the project. And as the project grows, that's where a lot of the tax benefits come into play, such as cost segregation. There's non-income tax benefits, such as property tax appeals, depending on each state you're in. More on the multifamilies, those are more at the tax tribunal, but definitely understanding those properties, and there's a lot of opportunity out there in the multifamily space for good operators out there.
Sorry, can you touch on that property tax thing that you just mentioned?
So in certain situations with the property taxes, and this was more common as the economy went down, but each of the jurisdictions are taxing the property based on the value and the income method, and on the larger properties. And I don't do it, but there are law firms that specialize in this and actually handle, if I have a 100-unit depressed property, that they're going to dispute the property taxes based on the value of the property. So maybe when it was renting for $1,500 a month per unit, and now there's a lot of riffraff and it's a bad neighborhood, and it's 50% rented, and I'm getting $600 a unit, and that value of that asset is substantially less. And in the legal arena, they're able to take it to the tax tribunal and dispute the property tax assessment value. So it's something to consider. And even when you purchase all the way down to small single family properties, if you buy a property in Detroit that's really depressed, needs a lot of renovation, really even saying that's not worth $80,000 that it was, what you think it is. It's depressed. It needs to be totally renovated. It has um, fire damage, whatever it may be. So, and on the residential side, when you appeal that, and if you do get your property taxes lowered, you're locked into that in the future, which is nice. So it is worth at least knowing that that's there. And I believe in Wayne County, I think that's all happening right now or in the next month or so, that the time to be able to bring that up. So if I bought a property that's in a neighborhood, I buy it for $15,000, but every home in the neighborhood's 80,000, and I just get an assessment of 80 because they say I probably bought it from a friend. I should go down and appeal that even at the single family level, because if I can get an assessment that it's worth 15 or 20, my property taxes going forward are going to be substantially lower than just accepting that assessment. And when you're buying a depressed property, it's worth taking those pictures and really going through that process. It's more done on the local levels for single family, and then larger, bigger deals start going up from there. So I do have investor clients and friends at the single family level that handle it on their own. Larger multifamily, you need to deal with a professional and deal with an attorney on that. So
I actually went to a meetup this past week, and that's what they were talking about, is getting your taxes lower in Detroit.
okay.
So the way they do it, usually the way people try to do it, is you go in, you pull comps, and you show them like, hey, pretty much try to prove to them that your house isn't worth what they think it's worth, right? And he was saying, and supposedly this guy's done a lot of them, and I'm sure he has, but they've learned that in Detroit you can't go in with, I think, what are they, CMAs or whatever, a realtor generates like
For the comparative market analysis.
Yeah. So supposedly that doesn't work. He said what works is you buy a house, it's run down, you take pictures of it, you go in and say, hey, I bought this house for like 20, 30K. I need to put in like 20, 30K into it. And you show them the pictures and how much it's going to cost for you to get the house to look like that. And then they'll lower the taxes. And what he also said to do is get them to lower the taxes, be like, hey, just for this 1 year, can you just lower them like as much as possible to help me out with the rehab? Because supposedly there was like proposal A or something
back in the 90s.
Yeah. So they can only increase your taxes by like 5%. So if you get 1 year of like super, super cheap taxes, it can only go up 5% from there. So it's actually
in the state of Michigan, knowing that you're in California, Tiffany, not sure how they work in California. So,
well,
the taxes are crazy. It's crazy.
Yeah. Well, you were saying you have property in Detroit, so it's kind of relevant to what you're doing.
But in that case, if the property's been renovated and now I come next year and now it looks nice, they're just going to lock it in at what it looks nice at. So it is worth doing that. And that's where at the single family level, you're dealing with human beings that can understand and see pictures. So the analysis is kind of beyond them. As you get into larger deals, you need to deal with the attorney, and just going in with pictures at that level probably won't work, I would say. But I think people tend to be reasonable if you can make a good case. But if you come in with your graphs and that, they don't understand, and that's where just the real world pictures, in that case, are going to help.
Going back to the cost segregation study really quick. So at what level would you suggest doing a cost segregation study? Is this only for large, big 20-unit buildings and up?
So I've been talking with, I don't do a cost segregation because A true cost segregation is an accounting analysis and an engineering analysis. And if you had a $10,000 renovation and you knew what was appliances and what was what, I would, we'd kind of pencil it in and do it accordingly. But if you buy a $500,000 apartment building, all I have to go on is building and land. As an accountant, it really needs to be done by an engineering study, and it doesn't matter how much experience I have or how many of these deals I've looked at or what the statistics are. You need to have it done by a true professional cost segregation, and that'll hold water with the IRS. The other analysis isn't going to stand up. So there, with that, there's a cost, and then really looking at the benefit of the cost of that analysis. I've seen them from $2,000 to $20,000 depending on the size and scale of the deal. I know there's a company online, I think, does them for $300 or something, and it's just some analysis, and they say it's good enough. But I'm not going to do your taxes based on that, just because that I think it's a nice. It's a real nice report that they give, but it's only a few pages, not really backed up by anything, and it was based on just industry standards. So in that case, that $300 report seems it would be worth it, but it's not going to hold water. But if you're looking at a $20,000 analysis, well, you need to make sure that it's going to benefit everybody. But usually a good company, if you call them, and there's a few out there, or many out there, but I know of a few, you can give them the rundown of your deal, where it's at, what the dollar amounts are, and they're going to tell you if it makes sense to do it. Then from there, will it make sense for you and your investors because of the passive and active rules would be my next step, because they're not doing your taxes. They wouldn't understand. They'll just tell you for $5,000 will free up all this depreciation that'll give you a deduction of $50,000. Well, that makes sense, but if you can't use it, then it's still not worth it. So I've heard 400 to 600, as kind of a good spot. Heard as low as 250, to start looking at it. But $100,000 properties, I would say, just understand the rules are there, but it's probably not worth even making the contact.
Yeah, if so, I'm under contract with a multi-unit, just a triplex, and the person just rehabbed it, like all 3 units, put in new water heaters and everything else. But in order to segregate out the improvements, like the water heaters and the rehab, would I need his receipts?
Well, really, in that case, you're buying just a finished, ready for rent property. So that's really all your documents are going to show. It wouldn't be that you're paying X for the property, that you'd be able to say, well, I know he spent a couple $1,000s on the hot water and the heating and that, and start carving it up like that. You could, between you and your accountant, but if it came into question, it could get thrown out. I mean, depending on the level of detail, it might be something that you looked at between you and your advisor, but just based on high level tax rules, it wouldn't necessarily hold up.
Yeah.
Because you still get the 27.5 year depreciation on that, right? So it's still better than commercial, which is a bonus.
Yes. So, and then one thing with multifamily, and it's way beyond this, but larger multifamilies, if there is some interest limitations, and in some cases they have to elect alternative depreciation methods if they have gross receipts in excess of $26 million, and that they would have to restate historical depreciation on residential to 40 years and anything new at 30 years. So it is technically slightly different, but I think for the most part, unless you have institutional partners, you're not running into having that situation. So. So hope, any other questions, or hope that kind of covered your question, Tiffany?
It did, yes, thank you.
Okay.
Anybody else? Where'd you guys see the Facebook or the Zoom call, I guess, the event for this? Did you guys see it on Facebook or?
They forwarded it to me, so
Okay,
I knew about it.
nice.
I saw it in my email and Facebook.
Okay. So, yeah, this was our first time. We thought hopefully be able to just bring some value as everybody's coming into 2020 and thinking about taxes for 2019, all the fun stuff. So hope everyone got something out of today, and really appreciate everyone attending. Feel free to reach out to Teo and myself if you guys have any questions. I can be reached at frank@cpanerd.com if anybody has any questions, or my number's 586-805-1040. Feel free to reach out. And Teo, how do they get a hold of you?
So my name's Teo Bogdan. You can find me on Facebook, or you can just give me a call or text 586-864-4415. 586-864-4415.
And then for everybody that's local, when's your next meetup?
Our next multifamily meetup is March 10th from 6 to 8.
Okay.
And yeah, we'll have Stuart Beal speaking. He's raised like over $100 million. He's got like 6,000 doors. So should be a really interesting guy to hear talk. He's also got a property management company, and he does all sorts of cool stuff. He does like residential, multifamily stuff, and also like commercial, like office space and stuff like that. So it'll be really interesting to have him share his journey of how he got there.
Okay. So thank you, everyone, and I think that's it. Have a great day.
Thank you.
Thank you,
Thank
guys.
you. Bye.
Enjoy the rest of your weekend.
Thank you.